Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, we do continue to really look at the markets from an in-depth perspective post the Canadian elections, and one key area of focus certainly should be the energy sector. And for that, we have Eric Nuttall joining us. He's a partner and senior portfolio manager at Ninepoint Partners. Eric, great to be with you today. I feel like the energy sector is almost a 5D chess game right now because we've got a lot of different potential relationships and negotiations going on between Premier Smith and Carney, Premier Smith and Trump. How are you looking at the sector today, big picture?
Yeah, it is incredibly complicated and volatile. Obviously, at the moment, we've got everything from demand worries, from the tariffs, not knowing how long and what the ultimate game plan is. We have obviously a new government in Canada, or maybe not a new government. Maybe, could it be 4 more years of the past 10? Could it be a shift? Time is going to tell, I think, in the next couple of weeks. We've got the dynamic, as you mentioned, between Alberta and the potential for a separation referendum. So there's a lot of different cross currents that energy investors have to deal with. Our stance now is we're bullish natural gas. We're neutral to bearish on oil. And we want to be largely invested in U.S. gas stocks and Canadian oil stocks. So in our fund now, we've got about a 65 to almost 70% weight towards natural gas, less oil now. There's just some headwinds that we have to deal with short term, with some very bullish developments, but that are going to take just a bit of time to play out. We think that the demand for oil, there's worries about tariffs and how that'll impact the global economy, which are very, very valid. I'm encouraged by some of the softening or apparent softening we're getting out of Trump with the UK deal. We'll see what happens with China and other countries. And so expectations now are incredibly bearish for demand growth. We've seen estimates as low as 500,000 barrels per day for this year. So sentiment is really washed out. Time is going to tell. To me, the real dynamics are on supply. We've seen a pivot from OPEC, key leadership there, where we have a voluntary deal of 8 countries, and they've accelerated the return of those barrels at a time when demand worries are very, very high. We can speak to why that is. We don't think it signals a battle for market share or a price war or some grand deal with the United States. I think it's really just intended to improve compliance from a few countries that were cheating on that deal. And then lastly, and I think this is the biggest bullish development, it's something we've been talking about for over a year, so it's gratifying. We've had several U.S. shale companies come out and affirm our view that the twilight of U.S. shale is here now, meaning U.S. shale has been the biggest source of marginal supply over the past 10 years. And what we're seeing is shale's likely entering a plateau and likely even a decline owing to a few different reasons. We've had major companies such as a Diamondback, which is, I think, the best shale company on the planet, come out and speak to that, talking about how the geology and the lowering of productivity, rising different dynamics. I won't bore you with details, but that's overwhelming any efficiencies, that they really need $70 oil to start growing again. So that's very, very encouraging. And that means that the oil market, as bad as sentiment is, and sentiment today is literally worse than during COVID, as bad as sentiment is, what we're dealing with is inventories that are very low, demand growth that is still growing at about 1 million barrels per day as of last month, the month of April. We have worries about what OPEC means. I think those worries are overblown. And then we've got U.S. shale that literally is entering into a period of maturity. And so the world has lost the largest source of marginal supply, which has basically really saved the world for the past 10 years. Without shale, non-OPEC supply would have already been in decline. That's what we see coming. So sentiment is bearish on oil. There's headwinds. I think it's just going to take time, but we remain medium to long-term bulls on oil.
Okay. That's what I was wondering from a bit of a longer term perspective. I basically understated the 5D chess. It's really 10 at least. So a lot of different aspects going on. So it's interesting. So right now, from a sentiment perspective, neutral to bearish, but longer term, when you look at the oil companies, it sounds like the shale players aren't the ones to necessarily be looking at, but does that give an opportunity to Canadian companies? We can pick it up on the other side of the break, but will that be the focus?
There's a massive opportunity in Canadian, especially oil sand companies and other companies in liquid-rich plays like the Montney and the Duvernay. They have decades worth of stay flat inventory, and they're trading at very depressed valuations owing to that sentiment challenge.
Okay. All right. We'll take a quick break. We'll be right back.